it's a good investment, and I lost all my money. It had the SEC's seal of approval. They don't do that. They don't tell you that, hey, this company is going to work out, right? That's part of the disclosures. You can't say that the investment's going to be good just because the SEC has approved it. They've just said it's legitimate. We've done all the things that the SEC requires, but you invest at your own risk because the SEC doesn't know about the market, right? Things can go wrong. The business model might not work. So just because the SEC is allowing the IPO, it doesn't mean that it stands behind the investment merits of what is going public, right? But I think that if you are an investor and you buy an initial public offering where the SEC has given the company the green light to go public, how can that same SEC a couple years later file a lawsuit against that company claiming that what it's doing, which is exactly what it said it was going to do in the prospectus that the SEC allowed? They're filing a lawsuit because Coinbase is doing exactly what it told investors and the SEC it was going to do before it went public. If what Coinbase is doing violates securities laws, why didn't the SEC say something before it went public? I mean, they obviously looked over what they were doing. If they were trying to bring public an illegal business, that was the time to say something about it. Because people invested in Coinbase, right? Yes, they didn't know if it was going to work out, but they at least thought what they were doing was legal. They didn't think they were running an illegal operation. But that's exactly what the SEC is accusing Coinbase of doing. They're saying Coinbase is running an unregistered, unlicensed securities exchange. Well, that's exactly what they were doing when they went public. They haven't changed their business model. It's the same business model that they reviewed when they approved the IPO. So to say that the government is going to basically sucker all these investors, allow them to buy stock, and then come and pull the rug out from under them and say that it's illegal. Look, that's another department that we should get rid of, the SEC. I don't think we should have an SEC. I'm not sure how many people work there, but we can save a lot of money. Let's get rid of the SEC. Let's get rid of FINRA. That's another regulatory body, which is not even part of the government. It's a private body that the government requires all brokers to be a member of. So I guess that wouldn't save the taxpayers any money because it's the investing public that has to pay the cost of FINRA. But the taxpayer does pick up the tab for the SEC. So if we're looking for ways of saving money, let's get rid of the SEC because clearly it's worthless. Because if what Coinbase is doing is so bad, why didn't they say so a couple of years ago? Why are they allowing the company to go public only to come back and say just 2 years later that what they're doing is wrong? Anyway, another thing, a topic I just want to discuss, because there's a lot about the commercial real estate market. I've talked about it. I've warned about it. So a couple of days ago, I went down to Yahoo Finance. I did an interview there. I'm not sure if they've posted it yet, but I did this interview. And when I showed up at Yahoo Finance, the guy that was there gave me a tour of their office. Very beautiful office in a high-rise building, lovely building. And this is a Monday. I'm there Monday at about 2 o'clock. Right? It's not a holiday. It's just a regular Monday in early June. Right? Everybody is supposed to be at work, except nobody was there. The place was completely empty. I actually took a little video and I posted it on my Instagram. Remember, I couldn't post the video on Twitter because I'm locked out of Twitter, but it's on Instagram, so you can check it out there. And by the way, again, as I said at the beginning of the podcast, follow me on Instagram and Facebook because that may be where I put content for a while I wait for Twitter to let me back on their platform. But I took this video of all of this empty office space. There wasn't a single person there. And the guy told me that before COVID, every desk that you see in that video had a person sitting there and working. It was very busy. There was this large cafeteria that they had just so, a perk, because if you worked there, you got all this free food. There was nobody there. And he said they used to actually had chefs there that would cook the food. But since there was nobody showing up, I guess they didn't need the chefs anymore. So they're not there. I mean, there's still some cold food there. I walked around. There was some stuff that I could have eaten. But there was nobody cooking anything because they didn't want to cook when there was absolutely nobody there. But the point is, what is this office space worth? Because nobody is there. You've got all these companies that have all this office space and nobody is using it. And I was able to see through the glass 4 or 5 stories down. And I could look through the glass at all the other offices that were below Yahoo, right? Totally different companies. Those were all empty too. I mean, just looking through it, empty desk after empty desk, nothing on the desks, nobody walking around in the hallways, just a complete ghost town. And this is before AI. I mean, people are working from home, but what about once we fully implement AI and people can use AI instead of employees? Obviously, if you're going to have a bunch of AI, you just need one closet where you put all those servers and those CPUs or whatever it is that you need to run the AI, right? You don't need a nice big office with beautiful views, and you don't need a cafeteria to feed your AI, right? They'll work 24/7, right? You just need the power to keep them going. So what's going to happen to this commercial real estate market when you've got big increases in interest rates? I'm here in the UK. Short-term rates in the UK are over 5%. You know where they were a year ago? They were 0. So they've had a huge move. And you know what they don't have in the UK? Fixed rate mortgages. Now that's going to residential. They don't have that. No, maybe people have 5-year mortgages here. They don't have 30 years like we do in the US. So, but in commercial, everywhere, nobody has 30 years really. It's a lot of short-term debt, 5-year debt. A lot of that stuff is maturing. So you own a commercial building. Your rents are collapsing. And even if they haven't collapsed because your tenants were locked into leases, what's going to happen when those leases mature? Are your tenants going to renew? Of course not. They don't need the space. So rental income is going to collapse. At the same time, interest rates are going up. See, commercial real estate is like a bond. The price of the real estate, the value, is a function of interest rates. The cap rate is interest rates. So if you have lower interest rates, then the present value of those rental streams is worth more. But you have a double-edged sword. If at the same time interest rates go up, your rental incomes go down, it is a perfect storm for the real estate market. And again, add to that the AI, which may increase or decrease rather the demand for commercial real estate, on top of the fact that so many people are now working from home. You're going to see a crash in the commercial real estate market. Now, that also has broader implications for the banks and other lenders who are not going to get repaid, because a lot of this commercial real estate has debt attached to it. And so the values are likely to fall so much that the losses are not going to just accrue to the owners of the commercial real estate. They're going to accrue to the lender, because once you've exhausted the equity. Let's say I bought a building and it was worth 200 million and I had 100 million of debt. I was like leveraged, 50% debt. And so the bank probably thought that was a pretty secure loan, right? We've loaned $100 million on a $200 million office building. But if that office building is only worth $50 million, the owner doesn't lose $150 million. The owner just loses $100 million, right? He walks away from the other 50 because that's the bank's problem, right? Because he's not gonna lose more than his equity because he just sends the bank the keys to the building. The problem is the banks own loans on a lot of buildings, right? I might be a landlord. Maybe I own one building, maybe I own two buildings, but that same bank may hold the mortgage on hundreds of buildings, thousands of buildings. So the losses for the banks are going to dwarf the losses for individual landlords of these properties. And now that has big implications for everybody, because when the banks lose money, well, what about the depositors, right? They're creditors of the banks. They've loaned their money to the banks. The banks took that money and loaded out against commercial real estate that has now crashed, and so they no longer have the security to make good these mortgages. So this whole thing is going to implode. And what does that mean? More bailouts, more money printing. And you know, when I was in Europe, I think it was two summers ago, I was looking at property. I didn't buy any, but I was kind of looking at it, and some friends of ours were looking at property, but really looking at property in Switzerland, in Italy. We were there for the summer, and they were giving out loans. I'm not making this up. And they were arranging these loans through brokerage firms, but they were actually paying you. It was a negative interest rate to buy a property. I don't remember what it was, like negative 50 basis points. But of course, remember, in Europe, right, they had negative interest rates. So you were able to buy a property and get paid to do it. Now, you had to agree to put some money up with a broker dealer. There was certain things that I had to do in order to qualify to get paid to buy a place with a loan. But it was there. And I remember thinking that this is so absurd, that the real estate market has got to be way out of whack to the extent that people are able to do this. How many people were buying properties simply because they were being paid to do it? And even if you weren't getting paid to do it, if you can buy it for free, no money down, then obviously there was a lot of demand that would not exist in a normal interest rate environment. Well, now we're beginning to have a normal interest rate environment. We don't even have one yet anywhere in Europe or the United States, because I still think that real interest rates are too low. Despite the fact that they've gone from 0 to 5%, when interest rates were at 0, most people believed that inflation was below 2%. Now they can see it's at least 5%, if not more. So we still have negative real interest rates. In fact, in the UK, right, they're way negative, right? Because I think their year-over-year inflation rate is like 8% still, or 10%, something crazy like that. And so they still have huge negative rates. But the markets are still distorted, and interest rates still have a long way to go up. So the residential market is in trouble. The commercial market, that's something that we didn't have in the 2008 financial crisis. That crisis was restricted to residential mortgage, because that's where you had the adjustable rate mortgages, the zero down, the liar loans, right? All that cheap money was concentrated in residential real estate. This bubble not only includes residential real estate because rates were at 0 for a decade, but it includes a gigantic commercial real estate bubble that has just run into the mother of all pins, right? Not just the pin of normalizing interest rates, but the workers that aren't going to the office and working from home, and AI, which is just starting, which is going to eliminate more workers. So this is a much bigger financial crisis. It's a much bigger real estate crisis. Just if you focus in on the real estate aspect of it, this is worse than 2008, except real estate is only one part of it, because you got the entire stock market, you've got credit cards, you've got student debt, you've got everything that has been impacted by over a decade of 0% interest rates. The bubble that we have now that has only started to deflate, and we've barely seen the early stages, right? We've barely seen the tip of this huge iceberg, right? When I said that with subprime, when we saw subprime, I said that's the tip of an iceberg. Everybody said, don't worry about it, it's contained. I would say, no, it's a tip of an iceberg. Well, what we've seen so far with these bank failures is a smaller tip of an even bigger iceberg. And so there's a lot more left that we're going to see once it rises above the surface level. Anyway, that's it for today. I'm going to be heading back to the U.S. early tomorrow morning. So I got to hurry up and pack and get to bed. And I will do my next podcast back in the U.S. of A. From my summer home in Connecticut. Bye for now.
Hi, everybody. So I decided to call this impromptu live webcast of my podcast based on the Fed's actions earlier today. No, I didn't realize that this is how I would be spending my day. For those of you who don't know, I am 57 years old today. And I guess this is my party, with everything on lockdown and social distancing. This is what passes for a social gathering these days. This is probably the closest thing to a party I guess I'm going to have, although I'm sure we'll have some kind of meal here later this evening at my house, but we won't have anybody over for obvious reasons. But I really wanted to talk today kind of live during the market hours, take everybody's questions again. But there's probably one thing that is spreading right now throughout the country faster than the coronavirus, and that is economic ignorance and misinformation. It's all over the place. It's gone completely viral. And I want to see if I can help put a stop to that, which is why I suggest that anybody who is watching this video blog now, take the opportunity to tell some people that that you're watching and that they should watch too, because the best thing they can do to combat the virus of ignorance is to turn off their television sets or their computers and don't listen to anything that is being said in conventional media, whether it's a news-related channel or a financial channel. I can virtually assure you that every single thing that you're hearing is wrong. I can also tell you that everything that is being debated on the floor of the U.S. Senate right now is wrong. And our leaders are now repeating the mistakes that they made in 2008. And back in 2008, I was a very, very vocal critic of the financial crisis. Of what the government did in the aftermath of that crisis. Remember, I was on television all the time predicting the crisis for exactly the reason it was going to happen. So it didn't surprise me. It surprised everybody else in financial television and on Wall Street, but it didn't surprise me at all. And I remember when they first announced the TARP, I was booked on the Cavuto show that day. He had a special live show. I think maybe it was even on a weekend, like a Saturday or something. And I was booked on live to come because I was going to talk about how this was such a mistake and how we shouldn't do it. And I remember I got down there, and while I was waiting to go on, there was some kind of bomb that went off somewhere. I can't even remember where it was. It wasn't in America, I don't think. It was in Afghanistan or someplace. I don't remember. And so they immediately cut to this coverage. And so I was about to go on. I'm sitting in my chair in the studio in Stamford. This is before I had my own studio in my house, which I also have in Puerto Rico, but I'm not using it right now. I'm just using my computer and my laptop on my desk. But I was sitting there in Stamford waiting to go on television to talk about TARP and why it was such a mistake and why we were doing the wrong thing and why it would be much better off if we just swallowed our medicine now. I was going to explain the mistakes that led to the 2008 financial crisis, why the Fed made those mistakes, and why it was compounding the mistakes now, and that the worst thing we could do was bail out those banks with TARP, that we needed to let banks fail, not because it was the easy thing to do, but because it was the hard thing to do and the right thing to do. And I was going to say, and I did say back then, that if we didn't swallow our medicine in 08, it was going to be much worse in the future. Well, you know what? welcome to the future. And, I ended up having an argument with some Cavuto that day because they cut me and they didn't put me back on. And I was quite upset that I didn't get a chance to speak because I thought I was the only one that was going to say anything valid and that was going to warn about the financial crisis. And basically, as a result of that argument, he stopped having me on his shows. So I haven't done any of those, those Saturday morning shows on Fox News anymore. But in any event, and I actually apologized to Cavuto because in retrospect, I think I got a little out of line with, my anger because I was really psyched up about being on that show. And I had, come back from the city especially to do it. And I really felt passionate about the fact that the country was making a big mistake. And I really thought I needed to get on the air, especially since I was really the only person that had been on Fox that had actually predicted it. But still, whatever I tried to apologize, but I to this day, I haven't been able to repair the rip. That's only one reason that I'm probably not on Fox. I mean, look, I'm not on a lot of other networks. I'm watching CNBC today. I haven't been on in years. And again, it is very frustrating to see these complete fools. And some of these people that I'm saying are fools are very smart people. They're just fools when it comes to their understanding of economics. And these same people who were so convinced that that the Senate needs to pass another bailout today. Well, it's the reason that we bailed everybody out in 2008 that we need bigger bailouts today. And we don't need bigger bailouts. We need them like a hole in the head. What we need to do is the right thing. But now doing the right thing is so much harder because we didn't do the right thing when I wanted us to do the right thing in 2008. And if you remember, back then, I warned that QE was wrong, that 0% interest rates was wrong, that we were going down a path that we could never turn from, that it wasn't just going to be QE1, which nobody even knew was QE1 but me, because they didn't have QE1 until it was QE2. But I knew from the beginning. In fact, I knew QE was coming before they started it. I knew what they were going to do before they did it. I wrote about it in my book, Crash Proof. I just didn't know what they were going to call it, but I knew what it was going to be. And now they won't even call it QE anymore because they're too embarrassed to call it that. So who knows what they call it, because they don't even have a new name for it. But when they did it in 2008, I said then, this is a mistake. It's never going to end. It's a monetary roach motel, more QEs than Rocky movies. Whatever the analogy was, I thought of it and I repeated it over and over again. And I said that the Fed could never get off of this once it started, that it would be QE infinity. And you know what? Now it officially is. The Fed finally came out today, which is why I'm doing this, and made that 2008 forecast a reality by officially declaring that they will buy as many government bonds and as many mortgage bonds and as much commercial corporate bonds as it takes, which means they're going to back up that truck and they're going to buy it all. The Federal Reserve is going to buy the entire bond market. And this is what I said was going to happen, because they are going to unleash a tsunami of inflation. And nobody would be dumb enough in the private sector to buy any of those bonds. And I said this from the beginning. I said if the Fed does this, eventually they're going to have to buy muni bonds. Eventually they're going to have to buy corporate bonds. I said this a decade ago, and they're doing it now. And they're using the coronavirus as the excuse. The coronavirus is going to be a scapegoat for everything that they do. But don't believe them. The reason we are so vulnerable to this economic downturn is not because of the coronavirus. I've said that from the beginning. That's the pin. The problem is the bubble. All bubbles find a pin. Doesn't really matter what it is. Now, I didn't foresee this particular pin. I mean, this is really probably one of the worst pins that any bubble could have found, but it didn't matter. But the problem is, had we done the right thing in 2008 and let businesses fail back then, let people lose money back then, far fewer businesses would be failing now. Far fewer people would have lost far less money than they're about to lose. And it's not a question of how much money people are about to lose. No. It's much worse than that. What we're going to suffer as an economy is far worse than losing your money. Because you know what's worse than losing your money? Having your money, but your money losing its purchasing power. That is the worst thing that can happen. And that is what's going to happen. Hyperinflation has gone from the worst case scenario to the most probable scenario. And that means people have to act quickly to protect themselves. Because, had we done the right thing, I want to buy something from a vending machine. That's the problem. Hi, Peter. I live in Brazil. I own gold and silver. I'm patiently waiting to invest in a Brazil fund, such as small caps. Yeah, Brazil stocks have been killed. We own one Brazil stock right now in our portfolios. We used to own 3. We got rid of 2 of them a while ago, years ago, but we still have one. In retrospect, we should have sold that one too, because we could buy it back cheaper now. But no, I think there's some opportunities. I mean, Brazil is not my favorite country. They have, it's certainly not even close in South America, but there's some good value down there. I mean, see, the difference is the U.S. stocks have gone down a lot, but they're still expensive, and they're going to get a lot more expensive after these bailouts and stimulus and all this draconian socialist legislation that's coming. But, I think there's a lot of bargains in the emerging markets. I think there's some really good cheap assets there with good dividends. And yeah, we're taking advantage of that. I mean, those are going to be good investments, I think, and they're going to be great inflation hedges when the emerging market currencies really start to soar, and it's the dollar that ends up submerging. Here's a guy from San Juan, Alan R, 20 bucks. It looks like the panic margin selling in gold is done. Do you think metals have bottomed? Most likely they have bottomed. Yes, I do. As I said, I didn't expect the correction to get much more than 10% when it started. This is a much more shallow correction. We had a 30% decline during the 2008 financial crisis, like an official bear market, before we went up to 1900. I think this is much more shallow. I think the next stop after we go through 2000 is probably somewhere between 5 and 10,000, but that's not going to be the end. See, I used to have a $5,000 target for gold back in 2008. And people made fun of me because we only got to 2,000. But remember, I had a $1,000 target when it was under 300, and we hit that. But Peter, you said $5,000 gold. It didn't happen. Yeah, it's going to happen now, except now we're going to be looking down at 5,000 instead of up at it. Because since we've printed and created so much money since I made that call, we're actually going to probably go much higher than 5,000. That call wasn't bullish enough. The difference is it's taking longer than I thought, but now we're going to get even higher than I thought. I wasn't wrong. I was early. It's the people who said it wasn't going to happen. They were wrong. They were wrong early, and they're wrong now, and they've probably always been wrong. An apple is $1 and gold is 1,500. 1 ounce of gold buys 1,500 apples. Money supply doubles. Apples are $2 and gold is 3,000. Gold has capital gains. Yes, exactly. That's the problem. If everything doubles, you don't actually have a capital gain in gold. Your purchasing power hasn't changed. And so if you sell and the government says, oh, you've doubled your money, we want half of that in taxes, you're actually poorer than you start. Now, are you as poor as the guy who didn't have gold and only had money in paper? No, because he lost a lot more than you did. But what if the capital gains tax goes to 90%? Then you're barely better off. Now, the key is, I think if apples double, the gold price might triple. And so the price of apples may actually go down in terms of gold, but not as much as the capital gains is going to hit you. That's why you need to be someplace without a capital gains. Or if you're transacting in physical coins, which is what I'm suggesting that you do at Schiff Gold, buy some physical coins. If you go out and use your physical coins to buy an apple, the guy who sold you the apple and got your coin isn't going to tell anybody that you gave him a silver coin for his apples. And so if you don't tell anybody, nobody will know, right? What do I think about anarcho-capitalism? What do you think a government should do about the coronavirus? Look, I'm not an anarchist. That's anarcho-capitalism is anarchy. I don't believe in anarchy. I believe in limited government. I'm very much on the same page as the founders. I mean, I think anarchy would be great if it could exist, but I think it's like a vacuum. I think when there's no government, some government is created, to fill the void. And so rather than waiting for a bad government to come into existence on its own, let's set one up with a lot of strings. Let's set up a limited government with a constitution now so that we know what we have before something worse just comes into existence. The problem is, you could set up a great government like our founders did, but over time, the government finds a way to unbind itself from those chains. And you lose the freedom. That's why everyone said, well, 200 years maybe will last, because they know what happens. But yeah, so anarchy would be good if it could last, but I just don't think it can, which is why I want to set up a limited government, which is hard to keep. That's the problem with government. Once you set it up, it's hard to keep a limit on its power, right? It's like that camel's nose under the tent. Kindly elaborate on the economic implications for the real crash in Europe. Look, there's a lot of problems in Europe, particularly in, some of the countries, Italy, Spain, Greece, Portugal, coronavirus making it even worse. And now the countries that are normally creditors, like Germany, now it needs to borrow. Everybody can't borrow. Somebody has to lend, right? It was okay when Germany and Japan and China were lending, other nations could borrow. But when they're borrowing too, we all can't borrow, right? Somebody's got to be on the other side of that transaction, right? Everybody can't be a buyer. Somebody has to be a seller, right? It takes two to tango. And so we all can't have a one-sided tango. It's just not going to work. So look, there's a day of reckoning coming in Europe and Japan, all over the world. People should own gold everywhere. People should own real assets everywhere. But I just think the day of reckoning will be particularly harsh in America. We have benefited the most from the fiat monetary system, and we will lose the most when it comes crashing down. Our economy is the most screwed up as far as the least percent of our economy being manufacturing, the most percent being services, the largest trade deficits, the largest budget deficits as a percentage of the real goods producing portion of our economy. Our government has guaranteed more debts and more liabilities than anybody else. And so, we're just set up for a bigger fall. We've had a bigger ride on the way up. It's going to be a bigger crash on the way down. That's why I think it's particularly important for Americans, but it's also important for everybody. So no matter where you live in the world, I think you will benefit from implementing my investment strategy long term. But it's not about short-term trading. If you believe that I'm right, that the music's going to stop playing, right, and there's going to be a big day of reckoning, and you want a portfolio that will do the best when that day comes, then that's what I'm doing. I'm buying the companies that I think will hold up the best. You got to have something. You got to, if I'm right and cash is trash, it will be, then what are you going to own instead of the trash? That's what I'm doing. I'm your garbage man to get rid of your trash. Well, people don't know it's trash. And let's get some real stuff. So if you're anywhere in the world, go to our website at europacificfunds.com and contact us. Your thoughts on fractional reserve banking? If we go back to the gold standard, what we have, Pat, look, fractional reserve banking, we had that under the gold standard. Banks loan money out. That's how come they can pay interest. That's the whole idea behind a bank. They're not going to keep all the money just in a vault. They're making loans. So there's always going to be some kind of fractional reserve. But in a free market with gold money, banks compete with one another for safety, and no bank wants a run. And so the way to make sure that you don't have a run is you don't make too many loans, but you also don't loan out demand deposits. See, there's a big difference between a demand deposit, at least there used to be. There's not anymore. The whole banking system is screwed up thanks to the Fed. But when we had honest money and honest banking, you had demand deposits and you had time deposits. People didn't loan out demand deposits because they were available on demand, and they didn't pay interest, because if they're not loaning out your money, how are they going to pay you interest? In fact, they charged you to hold your demand deposit because the bank wasn't making any money if it wasn't using your money. So it charged you for storing it. It charged you for having a checking account. You paid every month. You paid per check. That was a service that people were paying for. People don't pay for that service anymore because the bank takes your demand deposit and loans it out. Well, how are they going to loan it out if it's supposedly there on demand? That creates a completely unstable banking system. Now, if you had a time deposit, let's say you went to the bank and you said, yeah, I'm going to lock this money up for 5 years. I'm not going to come get it for 5 years. Now the bank is like, whoa, you're tying the money up for 5 years? I got 5 years to make loans. I can loan it to some entrepreneur who needs some new equipment for his business. I can loan it to this farmer right? Who, to get them through to harvest, right? I got time on the money. So now the bank can make a loan and maybe charge the farmer, 8% for the loan. But because he's charging the farmer 8%, he can pay you 3% for your money. And why does he have to pay you? Because there's another bank that can make loans and he wants your deposits. So everybody is competing by offering higher loans, but they can't offer too high an interest because they need a profit margin. And even on a time deposit, you're not going to loan out all your time deposits, because you know what happens? Somebody tells you, here's my money. I don't want it for 5 years. And they buy a CD. And then an emergency comes up and they go to the bank and they say, I need my money back now, right? Now, sometimes there's a small penalty if you break a CD early, but it's not that big a deal. But what no bank wants to do is tell somebody that comes to their bank because they need their CD early and says, I lost my job. I actually need the money now. I can't wait 5 years. Nobody wants to hear their bank say, I'm sorry, but we loaned it out. Come back in 4 years and you can have it. Everybody's going to want their money out of that bank. So people still didn't loan out. They still had their reserves, but it was the free market that dictated how much reserves you would keep in order to maintain your reputation and integrity. Because as a bank, the worst thing that can happen is people don't trust your bank, and now there's a run on your institution. So it's the value of reputation in a free market that keeps banks safe. And without government guarantees, banks, they shop around for safe banks. They don't want to put money in a bank that's reckless, that's making reckless loans, that doesn't have a lot of reserves, because that's their life savings. They don't want to risk losing it. The system we have today is completely nuts. The government corrupted it, right? All the deposits are guaranteed. So the minute the bank gets your money, they do all kinds of stupid things with it. It's all gone. And nobody cares because the government's guaranteed everything, right? And when it all comes crashing down, they blame capitalism. Oh, look at these banks. Look at all these crazy, stupid things they did. Of course, because the government made them do it. The government guaranteed all the loans. The government has deposit insurance. The government is going to bail them out if they fail. It's moral hazard, squared now. So we have the most unsound pain. Now it's going to be excruciating. We can't delay it anymore, right? We've now caught up to the can, and it's now so enormous that we can't kick it anymore. Getting back to what I said, if we had done the right thing and let businesses fail and let interest rates rise and replenished our savings and developed a viable economy that was self-sufficient in savings and production, right? Like it used to be when it really was a great economy. But instead, we inflated the biggest bubble that the world has ever seen, completely dependent on debt and consumption. And now that bubble is blown to smithereens, and we're going to have to deal with the consequences. The piper has been playing for decades. And the irony of it is he may want to be paid, but all we have is worthless currency to pay him in. So I think now this is like an official game of musical chairs. And you got to get out of the dollar. Not only the US dollar, not only US treasuries, but all US dollar denominated debt. Because all of it is going to get bought up by the Fed. Because any debt the Fed doesn't buy is going to soar in yield and collapse in price. And so that's why I think that long-term interest rates are not already soaring. It's because the Fed is in there buying. Because only the Fed would be dumb enough to buy US treasuries. In fact, it's not about dumb enough. It's desperate and insane enough. And the reason they're buying is because they create the money out of thin air. So what do they give a damn what it's worth? But obviously, people who are expecting to retire or live off of the income that those bonds produce, you'd have to be a fool to buy them. In fact, right now, as I said, it's musical chairs. When the music stops, if you still have any dollars, if you still have any treasuries, muni bonds, corporate bonds, cash value left in your annuity, in your life insurance, a fixed annuity, if you have any of that stuff when the music stops, you lose. And you don't just lose a game, you lose everything. And so you gotta make sure that you're sitting down before that music stops. And the obvious chair is gold, right? You gotta have gold. It's up over $50 an ounce today. You know, it's a good thing that there's so much ignorance out there in the financial media, because if people on CNBC or Fox or CNN or any of these networks, if they had one person on there leveling with the American public like I am and actually telling people what's going to happen and explaining the mistakes that the Fed and Congress not only made in the past, but is making now. And if you don't know by now, if you can't see how many of my predictions have come true, things that nobody else predicted but me, at least publicly, all this stuff is happening. Things that nobody could have even imagined. People thought I was crazy when I talked about this stuff a decade ago, and it's all happening now. And some people are just focused on, well, the stock market is still up. Well, the dollar hasn't crashed. You know, gold's only 1,600. If you wait until all of my financial predictions come true, just like all of my economic predictions and Fed predictions have been coming true one after another, well, then it doesn't matter. I mean, you can't help yourself. You're broke. But you still have the opportunity to recognize the truth of what I've been saying and the folly of what everybody has been saying in the conventional media, and recognize that these fools on Capitol Hill who are so convinced that what the markets need is another bailout. They don't need another bailout. We need a bailout from the bailouts, but the only bailout will work is the free market. We need capitalism to bail out the economy from failed socialism. Unfortunately, we're about to elect, Joe Biden. And even though he's not Bernie Sanders, he's going to govern like Bernie Sanders. He's going to be pushed to the left by the biggest economic crisis in U.S. history. Said, if you think the Great Depression was bad, you don't know anything about how bad this is going to be. Maybe so much worse. I said earlier on that during the Depression, the cost of living went down. This time, the cost of living is going to go sky high. You want to know what it's like when your money collapses in value? Take a look at some of the YouTube videos of Venezuela. You know, it's not pretty. You know, yeah, they're going to try to blame it on the coronavirus. Don't believe anybody. In fact, this is probably the best news the government has had. This is the best scapegoat they could have hoped for. Oh, the coronavirus, right? This couldn't possibly be our fault. Oh, this is another 100-year flood, which we seem to have every 10 years or so. But, oh, this is totally out of left field. Nobody could have predicted this. Look, bad things happen. That's easy to predict. Exactly what? Nobody really knows. But it's going to rain. It's not always going to be sunny. And sometimes when it rains, it pours. That's why you save for a rainy day. You don't pretend that it's never going to rain and leverage yourself up to the hilt. But that's what we did as a nation, because nobody wanted to pay the cost of saving for a rainy day, because you can't spend and save the same money. If you want to build a real economy, you got to stop spending. But if you have a phony economy based on spending, if you stop spending and start saving, then the phony economy implodes, which is exactly what you want a phony economy to do, because the sooner it implodes, the better, because the longer you prop it up, the worse it's going to be. And we've succeeded in propping it up for so many years longer than anybody could have thought, who understood the actual nature of the problem. So now it's going to collapse in a more spectacular way than even I imagined. So the economic outcome is going to be far worse than I thought when I was writing Crash Proof in 2007. I'm not happy about that. I really wish that cooler heads would have prevailed, and that, you know, the Austrian school and people like me and others. And again, I'm not the only one. Right? I don't want to act like I'm the only one that saw this coming. I just saw it coming and explained it in a more public way than a lot of other people. And it's not that I'm so smart. I mean, it's just that everybody else is so dumb. I mean, that's the reality. I mean, you don't have to be a genius to figure this out. You just have to be a complete fool, right, to miss it. Or you're just caught up in the moment. You know, that is the problem with bubbles, right? When you are trapped in a bubble, and there are a lot of smart people who have been in this bubble for a long time. And the problem is they don't know it, right? It's like that movie, The Truman Show, right? They think it's reality. They don't know it's fantasy. But I'm not inside the bubble. I've always been kind of on the fringes. And I've been able to look at everything objectively from the outside. And from the outside, you see the bubble, right? But nobody that's in it, they're all in it together, they have no idea. And so that's why, you know, it still hasn't dawned on them that they made mistakes in 2008. They still think it worked. That's the crazy part about it. It didn't work. If it worked, they wouldn't have to do it again. Think about how much quantitative easing, the trillions and trillions and trillions that have already been committed. I said this. I said that QE4, if we're going to count this as QE4 instead of 5, 6, 7, and 8, they've announced it. They announced a brand new QE program every day now. So I don't know if we just lump it all into one big QE or just keep on with the numbers, because we're already way through the Rocky movies. But why did I say from the beginning that QE4 would be bigger than QE 1, 2, and 3 combined? Because I knew that in order to try to inflate a bubble bigger than the bubble in everything that popped, they would need the most monetary stimulus ever. But I said it's not going to work. It is impossible. You cannot blow up a bubble that was bigger than the one we just had. And the reason these clowns think it worked is because the stock market made new highs. Real estate prices went up. So what? The stock market was overvalued. Even in 2008, it was overvalued. Making it more overvalued was a mistake. The real estate market was even more overvalued than the stock market. And instead of letting real estate prices keep falling, which was part of the cure, we made the economy sicker by pushing them back up again. And the reason we had the weakest recovery, but the longest lasting recovery ever, is because we didn't recover from anything. We actually got sicker the entire time they told us the economy was recovering. That's why Donald Trump got elected, because he leveled with the public about how bad the economy was and how the numbers were phony. The problem was, after he became elected, he conned the public with the same phony numbers and tried to get everybody to believe that the economy was great. And he was able to increase the illusion with deficits, with tax cut finance deficits. So he was able to blow extra air into the bubble to increase the delusion and get corporate America on board, get the Republicans on board to actually think that he had made America great again, instead of taking the bubble that he inherited from Obama, which Obama inherited from Bush, which Bush inherited from Clinton, right? We just made all those bubbles bigger. That's all we did. We continued the bubble blowing. Well, the bubble blowing stops now. This is it. And the Fed is going to destroy the dollar this time. The inflation is not going into the financial markets, right? That's why the stock market is not even really responding to the Fed stimulus. Yes, I think the market would likely be lower without all this money printing, and we may even get some kind of BS rally at some point. But gold is what's going up. The only thing is the dollar isn't tanking yet, and that's a short-term phenomenon because of this global rush for liquidity in dollars, because all this new money that the Fed is creating, a lot of it has just been committed. It hasn't actually gone into circulation yet. But once this short-term liquidity squeeze around the world ends, the dollar is going to sink like a stone. It is going to collapse. The only thing that hides how fast it's falling is that other fiat currencies are falling too, because central bankers all around the world are making the same idiotic mistakes we are. Governments all around the world are making the same idiotic mistakes our government is making. We are leading the idiot parade, and they are following us. But the difference is other economies are much sounder, right? They're the producers. They're the creditors. They don't have a complete house of cards, phony economy like we do, and they do not issue the world reserve currency. No country is going to suffer more than the United States when the current fiat monetary system comes crashing down, because we enjoy a privileged place in that system as the issuer of the reserve currency, which is a ticket to live beyond our means, to consume without producing, to borrow without saving. That's all going to come to an end. And then we're going to find out what the real problem is. The real problem isn't that consumers aren't spending. The problem is they have nothing to buy. The stimulus that has already been offered by Trump, this new stimulus package, equals like 10% of GDP. 10%, we're just getting started. During the Great Depression, for the entirety, between 1929 and 1941, just before World War II started, the entire Keynesian fiscal stimulus was only about 3% of GDP. That's it. Government spending increased by about 9% of GDP, and taxes increased by about 6%. And so the difference was 3%. That was the stimulus. That was it in the Depression. And ironically, it was the stimulus that helped create the Depression. We didn't need stimulus. We didn't need more government. We needed to be relieved with less government. Had they cut government spending instead of increased it, there would not have been a depression. That's the irony. That's what happened in 1920. 1920 got started worse than the Great Depression. The problem was it was over so quickly, they never had a chance to pass the stimulus. That's what happened. It was really, really bad, but Congress didn't get around to doing anything. And as a result, the economy healed itself. The reason we had a Great Depression in 1929 is because we weren't that lucky. Hoover came in with his idiot bailouts and stimulus, whatever they did, and turned that downturn into a Great Depression. Well, the idiots we have today, and again, the guys back then were geniuses compared to these morons. What they are going to do is they're going to turn what could have been a very severe recession into something much worse than a depression, into a inflationary depression. So as I said, you got to buy your gold, Schiff Gold. I know the guys are there somewhere answering the calls. Gold and silver, that's real money. Buy it now. I know you're going to wait 2 or 3 months to get your silver. Well, if you wait much longer to buy it, you might be waiting 6 months, a year. We may run out. Who knows what's going to happen with gold and silver? Just buy yours while you can. Use for investments. If you got bigger portfolios, you got to get out of all U.S. treasuries, muni bonds, corporate bonds, anything that's a promise to pay you dollars. Because the only thing that's going to buy less than the dollar today than the dollar in the future. And the further in the future it is, the less it's going to buy. So get rid of them. The Fed is giving you a get out of jail free card. The Fed is buying all the bonds. Sell them yours. Don't be the last one to unload their bonds on the Fed, because the longer you wait, the less purchasing power you're going to get. And you want to get into foreign assets. That's why I've been saying it's not about the market going down. It's about the dollar collapsing. Because in order to save the market and the phony economy, they sacrifice the dollar. Well, they're going to get a lot more than they bargained for. It's not like the dollar is just going to get a little beat up. It's going to get completely slaughtered. And so you got to do something. You got to move your portfolios out of dollar-denominated stuff, out of U.S. stocks too. Even though U.S. stocks, the ones that don't go bankrupt, won't lose as much as bonds. But I think U.S. stocks are going to be so taken over by socialists in Washington. There's going to be so much worker-friendly regulation that basically effectively nationalizes the major American corporations. They're going to be run as worker cooperatives. Like no one's going to give a damn about the shareholder. So before the shareholders figure out that they're the patsies, sell your U.S. stocks. You need to be aware of this political risk, because the worse the economy gets, the greater the political risk, right? The more of our individual liberties are going to be lost as people are scrambling for somebody to help them, not knowing that the reason they need help is because of all the government help in the past. That wasn't help at all. The government causes all the crisis and then comes riding to the rescue, right? They're the firemen that light the fires. And then they say, oh, look, we're here to put it out. Yes, we'll stop lighting them. So you got to get out of your U.S. assets. Talk to my brokers at Euro Pacific Capital. Transfer an account over, IRAs, retirement, regular accounts, so that we can manage the money outside the U.S. Yes, I know other countries are screwing up their currencies. There's going to be inflation all over the world. The difference is there won't be hyperinflation all over the world. There will probably in the United States. The other countries aren't going to lose their reserve currency status because they don't have it to lose. Other countries are already producing more than they consume. They're already saving more than they borrow. They are viable. It's America that's in for a rude awakening. We have a date with destiny and an awakening coming, but you don't want to be there for that awakening. You don't want to keep that date personally. I mean, as Americans, we're going to have to deal with it, but I'd rather deal with it as a solvent American than as a broke American, because the vast majority of Americans are going to be wiped out by this. They're not going to be wiped out by the coronavirus, but by the government's cure for the coronavirus that started long before anybody ever thought up the word coronavirus, right? We started this decades ago, and Alan Greenspan may have started it, but Jerome Powell is going to finish it, most likely, unless somebody else gets appointed by Biden who's different. And then that person maybe will be the fall guy or gal. We'll see. But this is not, there's not another 10, 12 years. That's not going to happen. Don't think there's any way that that's going to happen. We have now accelerated the time scale. Think about where you were a month ago. right? Did you think any of this nonsense was possible? Had you ever seen anything like this outside of a science fiction movie? No. Well, as I said, you ain't seen nothing yet. It's going to get a whole lot worse. And before it does, at least get prepared financially, and then maybe try to get prepared emotionally. Anyway, let me try to take some questions. I know there's a bunch of questions. I got to turn. Is there a password to this other computer? Yeah. Because it's better not to have them because it just makes it harder to get in. All right. So I'm going to start taking the questions. I guess I take them in order of the dollar value. This is a $150 question. And pretty soon, $150 will be what you pay for a carton of eggs, if you're lucky. And then the question is, well, how long will it be before that same carton of eggs costs $300? And then how long before there is no carton of eggs? And if you want a carton of eggs, you got to find the farmer, and you got to give him some silver. Otherwise, he's not giving you his eggs. Anyway, let me see this question. It says, is Euro Pacific Capital compliant with AAOIFI standards, accounting, auditing, financial institution is worth doing? The floodgates of mud. I don't know. I mean, I'm not familiar with every single rule, but we're compliant with everything that we're required. I'm not the compliance officer. And Euro Pacific Capital right now is a division. I sold the BD. The new owners renamed it Alliance Global Partners. And yeah, I mean, they got a chief compliance officer. We got all kinds of guys that make sure we comply with all of the FINRA rules, all the SEC rules. Most of these rules, I think, are counterproductive and simply run up the costs unnecessarily by design as a mechanism to keep out competition for the major broker dealers. That's how all regulation works. Government regulates small business to make it harder for small businesses to get started and make it harder for those who are in business to stay in business. All of it is about protecting the larger corporations that basically buy the politicians with their campaign donations. Anyway, next up is Adam, who is a huge fan. Please discuss economic rise of Germany despite World War I reparations and the Great Depression of using debt. Well, you know, Germany, I mean, the big problem with Germany is Weimar Republic and hyperinflation. And that's where you can go and see the examples of money being carried around in wheelbarrows. And there's a famous story about somebody who left a wheelbarrow full of Reichsmarks on the sidewalk and went into a store. And when they came back out, their money was on the ground and the wheelbarrow had been stolen. Right? That just shows you how quickly money can lose value. And you know what happened to Germany is after the war, the Treaty of Versailles was extremely harsh on Germany. And that was probably a byproduct of the United States having entered the war. And we fought with, the UK and our allies and really crushed the Germans. I think without the U.S. entry into the war, they probably would have negotiated a peace and it would have been more balanced. And therefore, Germany would not have gone through the hyperinflation, which gave rise to Adolf Hitler and World War II and concentration camps. And so you never know what's going to happen, when you knock over the first domino, which is why it's always good not to get involved in foreign wars, because you never know how much greater a problem you might be creating than the one that you think you're solving. But in any event, what happened to Germany is they had agreed to a lot of war reparations. The Germans agreed to pay.
And Janet Yellen's answer was, well, that wasn't our intention. Well, sure, maybe that wasn't her intention. But the problem is, just like all these politicians and bankers, they don't understand unintended consequences. Because just because you don't intend to do something doesn't mean that it's not going to happen. You have to follow the steps, the moral hazard, connect the dots, which is something nobody in government does. They simply blindly look at a policy and they say, we're going to do this, and they expect all these good things to happen. But then they don't understand what the policy itself is going to produce, the result, the moral hazard of your policy. So the minute the government decided, oh, we can't allow this bank to fail because it's so big, we have to protect the large deposits. They're sending a message to every customer of a small bank, you better get out of that small bank because that bank might fail. It's probably loaded up with treasuries and mortgage-backed securities, just like Silicon Valley Bank was. But if you're in some little, bank, you're on your own. Who the hell wants to be there? How can these banks survive? So now, what does the government have to do? Right? Well, they have to, two wrongs make a right. What the government has to do is now they have to explicitly extend that coverage to every bank. They have to now change the FDIC, and they have to say, don't worry, we will cover 100% of the accounts for everybody. So they make one mistake, and now they have to follow it up by making another mistake to try to counteract the mistake they made in the first place. No, they're not going to reverse that decision. They never do that. They never make a mistake and then undo the mistake. They just make more mistakes to try to counteract the damage of a prior mistake. So that guarantees that you just compound one mistake on another mistake. But all of this means inflation spirals out of control because either we have this banking crisis because they don't extend the FDIC, or they do extend it, and that means the federal government assumes trillions and trillions of additional liabilities onto the debt. And this is a warning sign to the entire world of what's about to happen, which is a dollar crisis, a sovereign debt crisis. Because as I have been warning, this is the moment where the world finally wakes up. It's the emperor has no clothes, because Powell was saying, don't worry, we have the tools, we can fight inflation, we can bring it back down to 2%, it's not going to hurt the economy, everything is cool. And then a couple of weeks later, we're in a financial crisis. And even though inflation is still 6%, they're back to quantitative easing. They've had to call off the rate hikes, getting ready for rate cuts. What does that tell you? What I've been telling you. Inflation is here to stay. The Fed doesn't have the tools to bring inflation back down to 2%. And if it has them, it will not use them because of the collateral damage. In order for the Fed to follow through with its commitment, it has to ignore the financial crisis. But it's already chosen not to. It's already showed its cards. It backed this bank bailout. It expanded its balance sheet. It went from doing quantitative tightening to quantitative easing without an announcement, nothing. They just went and did it. What does that tell you about its resolve to fight inflation? It was BS the entire time, which is exactly what I said. I said the Fed's willingness to fight inflation would only last until there was some real damage in the financial system, in the economy. And that's what happened. So as long as they can pretend everything was great, they can pretend they would fight inflation. But now that they can no longer pretend that everything is great, then they have to stop pretending that they can fight inflation. And when the markets now realize that inflation is not going back down to 2% ever, it is going to be much higher than that, they have to reprice a lot of assets. Now, they should reprice the long-term bond market, but the government won't let that happen because they're going to be printing a lot of money to try to buy up those bonds to keep the prices from falling and the yields from rising. But they won't be able to stop the dollar from falling, especially in the environment today where so many other countries that used to be the biggest buyers of dollars are now trying to de-dollarize and get rid of dollars, and they're not going to be able to stop the price of gold and silver from rising. Because if you have to now recalculate what gold is worth in a world where inflation never comes back down to 2%, let's say it's 6, 7, 8%, I think it's going to go into the double digits officially, which means unofficially it's in the double digits where the first digit is a 2 or a 3. It is massive inflation. Now you have to figure out what is the present value of gold in that world. It is much higher than 1900. It's higher than 3,000. It's higher than 5,000 in my opinion. Now, will we get to 5,000 next week? Probably not. But we can get a lot closer than we are right now. We can gap right through 2,000. We can take out the all-time high, which is not even 2,100, and then we can have a moonshot. And obviously, if gold's going to the moon, silver is going to go further. So maybe silver is going to go to Mars or Venus or something like that. So again, what I would do, and this is not panic, I recognize that it's possible that this doesn't happen, that maybe the price of gold and silver pull back next week. I don't know. I don't think there's a lot of downside risk, though. Even if you buy it over the weekend at Schiff Gold and you get a little pullback, it's like, I could have waited till Monday and I could have saved a little bit. It's better. What if we just take off? What if gold gaps up $100 on Monday? And then what if the premiums really skyrocket on Monday because people try to buy these coins and there's no more left? Because that's the other thing that happens. Not only does the price of gold go up, but the premiums for the physical gold go up even more. Because I think everyone around the world, really, they want to get out of the banking system. And, what are you going to do? I mean, why do you think Bitcoin, I think this is a sucker rally, but Bitcoin surged again today. Let me see where it is. Bitcoin is at just under 27,000 now. Big jump again today because people are rushing into this as a safe haven. I think they're going to get burned. They're in for a rude awakening. The real safe haven is gold and silver, but people are worried about this banking crisis because they're damned if they do it, they're damned if they don't. If the central banks bail out the banks, then the money in your bank account loses tremendous value. If they don't bail out the banks, then you lose your money because your bank fails. So either way, you don't want money in the banks because either you get your money back and it has little value, or you don't get your money back at all, or you get some of your money back. So you want to get out of the system, you want to withdraw money from the bank and buy gold or silver. And this is not just in the US. I think this is going to happen all around the world as we have a loss of confidence in banks and government guarantees, and everybody around the world starts to brace for even higher inflation. For years, they've been lying to us. There's no inflation. Then when it reared its head, they said it was transitory. Then they told us, don't worry about it. We're going to fix it. Well, now the world's going to know they can't fix it. They're going to have to worry about it more than ever. Inflation is going to eviscerate the value of everybody's bank account unless they act quickly to turn their fiat currency into real money. And again, as I've been saying, if you really want to make a killing off of this, you buy the gold stocks, but you can't buy those over the weekend. We're not open for business in the stock market probably until Monday morning. So if there's a big gap up in physical gold, then these gold and silver mining stocks may gap up on Monday. But even if they do, it's not too late to buy them. I mean, I think that we have a long way to go, even if they do have a big jump on Monday. We're just getting started. I mean, the train is leaving the station, but you still have a chance to run and jump on there and
lend money to the Japanese government for 10 years at 40 basis points when inflation is 330 basis points. Well, no, idiot. That's the problem. The only ones dumb enough to buy those bonds is the Bank of Japan. But they know that if they take away the yield curve control, if they stop creating more inflation, then yields are going to spike. And that's going to force the Japanese government into a untenable predicament because they won't be able to make the payments on the debt. And there's going to have to be a massive day of reckoning in Japan. And so to avoid that political decision, the Bank of Japan is continuing to create more inflation, claiming that there's not enough. Now, at some point, the markets are going to stop believing the Bank of Japan. In fact, the Japanese yen fell about 1.25% on this announcement, but we haven't had a complete collapse yet of the Japanese yen. But as the markets start to see through this charade, it is going to put tremendous pressure on the Bank of Japan. But the reality is the United States is in even a worse predicament than is Japan because of our twin deficits. Japan still operates with a trade surplus, and Japan is still a creditor nation. The United States is the world's biggest debtor nation. We owe a fortune to Japan. The Japanese government holds over $1 trillion of U.S. treasuries. So one way the Japanese can try to alleviate their problem is by dumping those treasuries. They can sell those treasuries and then use the proceeds to pay down some of their own debt. We don't have that luxury. We owe everybody. We're not a creditor like Japan,
but the Bank of Japan is already trying to spare Japanese politicians from having to make these difficult choices that they would have to make if the Bank of Japan were to allow rates to rise. Well, the Fed is going to be in a similar predicament soon. Yes, the Fed has been able to raise rates. We got interest rates up to 5%, but we really can't move them much higher because we've already seen the adverse consequences in the banking sector. We've already seen the failure of 3 or 4 major banks. Many more banks would have also failed but for the government backstops. But if the Fed continues on this trajectory, the government might not be able to provide this support. And a lot of these banks that have gotten a reprieve are going to fail. In fact, more negative news in the commercial real estate market. I was reading about more high-profile defaults on commercial real estate. Sterling of Greenlight, I forget for the name of the company that they operate all these hotels, and they just couldn't make their payments on a couple $100 million loan on a piece of property, with big warnings out there about the commercial real estate sector and all of this debt. I think it's like $500 million of debt coming due in the next year, several billion over the next few years. And there's not going to be any way to finance this because the value of the collateral has already collapsed. And again, I've been warning about that for years and years when so many people on Wall Street were looking forward to rising interest rates because they thought that rising interest rates would help the banks earn more money because they could charge higher rates. I was one of the few people pointing out the damage that higher rates was going to do to their balance sheets, to their assets, to the loans, the long-term loans that they had already committed to, all of the treasuries and mortgage-backed securities that were on their books. And so all of these chickens are coming home to roost right now. And this is putting a lot of pressure on the Fed. In fact, I was reading an article today on rents, and Moody's, has been tracking rents for about 20 years. And they're looking at, what the typical homeowner pays in interest on, or not in interest, in rent as a percentage of his income. And when they first started keeping track about 20 years ago, the average renter spent 23% of his income on rent. And 10 years ago, that was up to 26%. Today, it's now a record 30% of monthly income going to pay the rent. Now, this is also pre-tax income. So obviously, your after-tax income is diminished, but they're just looking at your pre-tax income, which is not really your take-home pay. But of your pre-tax income, people are spending 30% of that on their rent. Now, what does this mean? This means that people have less money left over for other things, or if they're trying to save up a down payment to buy a home, well, they have less money available to do that if they're spending more on their rent. But that's not your only cost. If you're, renting an apartment is the rent, because you also have to pay utilities, and those rates have been going up. So there's other costs that a renter is going to have to pay that relate to renting a place, and all that stuff is going up. And this is evidence of a diminishing standard of living. That is why a lot more people have to take second and third jobs, because more of their income is going to rent. Now, 30% is the average. That means that there are some people who are actually paying a lot more than 30% of their income on rent. And that is a big number. But I was reading this article too. It was more of an advertisement, really, disguised as an article from a company that's in the mortgage business. And they're trying to persuade people to buy homes because, of course, when you buy a home, you take out a mortgage. Now, I did read, too, that turnover in the housing market is now also at a record low because there's a huge spread right now between what sellers want for their homes and what buyers can afford to pay. Because the sellers are still looking at prices from a year or two ago, but buyers can't afford those prices because mortgage rates are so much higher than they were a year or two ago. So there's a big disconnect between what sellers think their homes are worth and what buyers can actually afford to pay for those homes. So it's a huge spread. And so right now what's happening is just there's no transactions because the sellers don't want to come down. The buyers can't come up, right? So it's like a deadlock. And so you're seeing minimal turnover in houses. And again, another thing, and I pointed this out, was that a lot of people, one of the reasons they don't want to sell their homes is because they can't buy another one, because they can't port their mortgage. If you've got a 30-year fixed rate mortgage on a home, the only way you can keep that mortgage is to stay in your home. If you sell and try to buy a different home, well, you're going to have to get a brand new mortgage at a much, much higher rate. So that has really frozen a lot of people in their current homes. And that may be a reason too that people may even pay a mortgage if they're underwater, because what they're really trying to preserve is not their home, but their mortgage. That's their great asset in that they've borrowed all this money on the cheap and they have, 25 years or how many years left to pay it back. But I know I got to take one more commercial break.
And again, as I started to say, and swallowed the medicine, as bad as it would have tasted, a healthy economy would have emerged instead of the bubble that we inflated instead of having a healthy economy. Donald Trump, again, was saying that before the 2008 financial crisis, before the coronavirus crisis, we had the strongest economy in the history of the world. That isn't even close to being true. The fact that Donald Trump is so clueless about the economy and the fact that all of his advisors are so clueless about the economy, they're never going to know what to do. See, everybody wants us to go back to normal, the way things were before anybody heard the word coronavirus or COVID-19. Not even sure what to call it anymore. But you know what? We weren't normal back then. The economy was sick before the virus infected us. It was a bubble. There was nothing normal about that bubble. And the problem with bubbles is once they pop, they're not going to reflate. You need a new bubble. You need a bigger bubble. That's what the Fed did. They inflated the NASDAQ bubble. That popped. They inflated a bigger bubble in housing. That popped. And then they inflated a bubble in everything. Well, everything's already been in a bubble. There's nothing left to bubble up. It's over. Now, when I was talking about hyperinflation in 2008, everybody's been saying, oh, Peter Schiff was wrong. He said there'd be hyperinflation. Paul Krugman has even called me out. He was wrong. He said there would be hyperinflation. I wasn't wrong. I was right. There probably will be hyperinflation. I didn't say how quickly it would come. Yes, I'm a little surprised that they were able to kick the can down the road for over a decade. Yeah, but all that did is make the hyperinflation outcome that much more likely. And yes, all of the inflation that the Fed created with QE 1, 2, and 3, that went into financial assets. What do you think made the stock market go up? What do you think made the real estate market go up? That's all inflation. Everybody wanted to turn a blind eye to that inflation and deny it was there. Oh, it's just, asset prices. Those are prices. And they went up because of inflation, which is an expansion of the money supply. Let's get our terms straight. That's literally what inflation means. You find an old dictionary and it'll define inflation as an expansion in the supply of money and credit. Rising prices are an effect of inflation. They are a result. Inflation is what the Fed is doing right now. If you watched 60 Minutes last night, you saw Neil Kashkari for the Minneapolis Fed president. In his interview, he admitted that Congress has asked the Fed to literally print money as much as possible. And Kaskari said that the Fed is flooding the economy with liquidity, that it digitally creates out of thin air. It is electronically dropping money from helicopters by order of the U.S. Congress. And when he was asked, well, is there any limit to this? The answer was no. We will print an unlimited amount of money. And I take them at their word. But there is an end. They can't do it without end. It will end with the dollar's value coming to an end. It will end with hyperinflation. They will print money until the money they print has no value. So what good are all the bailouts going to be? What good are the checks that the government is going to be sending out for people not to work? And by the way, it is asinine for the government to try to keep businesses employing workers that they don't need. If you are a business and your customers are not there, you should lay people off. That is economic reality. Trying to encourage or subsidize businesses to maintain a workforce that, in the judgment of the business owner, he should reduce to ensure the solvency of the business, that is a mistake. You know, a lot of people don't understand this because they don't understand history at all. They don't understand the Great Depression. But one of the biggest mistakes that Herbert Hoover made in 1929, just after the stock market crash, there was an asinine idea, although compared to the asinine ideas we have today, it was probably brilliant. But the idea back then was that businesses shouldn't cut wages, that it would be terrible if businesses reduced what they are paying their workers, because it would have a cascading effect throughout the economy. Workers would earn less, so they'd spend less, and it would just be a vicious cycle that we could never get out of. So economists of the day, a lot of them were saying, okay, Hoover, we can't let businesses cut wages. So all the big companies met with President Hoover, and they all promised Hoover, okay, we're not going to cut wages. We're going to keep everybody's wages where they are. The problem is everything was deflating. Prices were going down. Raw material costs were going down. The business was contracting. All of that meant wages were actually rising. The failure to cut wages when they needed to be cut meant that labor costs were too high. And so what did businesses do? Instead of cutting their wages, they cut their payrolls. They fired workers rather than lowering their pay. Had people lowered pay in the Depression, unemployment would have surged. And it was okay if people got less pay during the recession because their cost of living went way down. Food prices went down. Energy prices, the cost of living plunged during the Depression. So if your wages went down along with your prices, your standard of living didn't change. The problem is those idiots, the government, got together with business and decided not to cut wages. And so they fired people instead. Well, this is another example of governments doing the wrong thing. We don't want to pay businesses not to lay people off that should be laid off. That is malinvestment. It's a misallocation of labor resources. That labor needs to be freed up to do something productive, not stuck in a restaurant with no customers or stuck in a hotel with no customers. I mean, what's the point? And, you know, the whole idea that, oh, well, everyone's going to be back to work in a couple of weeks. We don't know that. We have no idea. And in fact, now we've given businesses an incentive not to get people back to work if they even were going to do it. But you know what? Even if this virus is cured in a few weeks, right, or we think it is, do you think that business is just going to go right back to normal? Do you think that people are going to just go out in crowds right away and take a chance? I don't think so. I don't think business is going back to normal anytime soon in a lot of restaurants where the public, congregates. And unfortunately, 70% of the U.S. economy is this consumer spending borrowed money. So we have a lot of people in restaurants, a lot of people in bars, and a lot of people who are employed there. And Americans are just not going to go out as often for a little while. They're going to want to make sure the coast is clear. And also, you know, a lot of employers, now that they've been mandated paid leave, not only medical leave, but family leave, they would be reluctant to hire people anyway. Because what if all of a sudden, a few months later, here comes the virus, it's back. We got to lay everybody off again. And now you got to pay everybody's leave. You got to pay people to hang out with their kids who aren't in school. But look, all this is a mistake. right? This is going to destroy businesses. This is going to guarantee that the businesses that we bail out are going to be in more trouble in the future than they are today. And they're going to be in constant need of bailout. The same thing is going to happen with any of these big companies that we bail out. We're going to put so many strings on the bailouts that we guarantee they'll never be globally competitive again. We are destroying our industry, our economy with government. And I was right. We are going to have hyperinflation. Now, maybe we'll avoid it, but the only way we're going to avoid it, things are going to have to get really, really bad. We're going to have massive inflation, right? So hyperinflation, in my mind, is Zimbabwe, Weimar Republic, Venezuela, Argentina. That I think is where we're headed. Now, it's possible that we don't completely get there, but in order to avoid that, it's going to be horrific in this country. And if we don't avoid it, it will be worse than that. Anybody who thinks that what they're experiencing now, is kind of apocalyptic, this quarantine and social distancing, I agree. It is really surreal and bizarre. But it's nothing compared to the economic crisis that's coming. And a lot of people think that the economic crisis is coming because we're all shutting down the economy because we, want to contain the virus. No, that's just the tip of the iceberg. The real crisis is so much worse than that. This is a monetary crisis. This is a sovereign debt crisis. This economy is going to completely implode, and there's going to be nothing we can do about it. And the cause is not the coronavirus. The cause is the Federal Reserve. The cause is Congress. And it started back in 2008. Really, it started earlier than that with Alan Greenspan. It started probably after the 1987 stock market crash, and then continued with long-term capital management and Y2K and the Asian debt crisis, all the things that Greenspan did to temporarily delay the